Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
What's money really worth? The answer will surprise you.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, five-time author and fiduciary, the money missionary himself, Tony Walker.
Welcome to the Worry-Free Retirement. I am your host for the next 28 minutes or so, Tony Walker, and we're glad to be bringing you this show recorded up in our Louisville studios, December 12th, 2017. Incidentally, the new building here in Louisville is fastly on its way to being improved. We purchased a building over on Shelbyville Road, conveniently located near Watterson Expressway, going through some major renovations, so we hope to be in that in spring. And I know Aaron, America's favorite financial sidekick's excited because we're going to have a brand new large studio. That's part of the rehab of this building to bring you hopefully even better quality shows for the Worry-Free Retirement. Incidentally, we thank you so much for watching the show. Appreciate your comments. Anytime you have a question for the show, just go to TonyWalkerFinancial.com. Be happy to try to get that on. Well, the intro to this show was regarding your money. And what is money really worth? It's going to be a very interesting show for you today, and I think before we move forward, we need to first understand very briefly the concept of what I call OPM, other people's money. In fact, in my book recently, I wrote Don't Follow the Herd. It talks a lot about other people's money, and I believe that before people can truly understand money, marketing, different ideas out there for making money, that we have to all realize that money in and of itself is really kind of an arbitrary term, and money either is going to be earned or it's going to be, as we're going to see, created sometimes out of thin air. So either way, someone has got to place a value on money, and sometimes we're going to see also this can be based on speculation, what we call the law of supply and demand. And money should be, and it's not anymore, but it should be based on some sort of standard, whether it's based on the standard of gold or some sort of government bank or institution that helps us value this money. Now, we're going to go through a lot of examples today, but to use an example of money and how over time money, although it's real, is kind of funny money. In fact, I'm holding in my hands here two different types of denominations of bills. And there's a reason I'm doing this. One is a $100 bill. The other is a $20 bill. Now, I'm going to go back in time. Growing up in Lexington, Kentucky, I was at the ripe old age of 16, and I was working at the Kentucky Horse Park there in Lexington. Back then, it was just started and a beautiful facility, but there wasn't much there. In fact, they had a equestrian show. I didn't know anything about horses, but someone said, hey, Tony, you can get a gig over there setting up jumps for the equestrian riders. And what you do is you set the jumps up when the horses knock the rails over or knock the windmill over or whatever the prop was. You run out and set it back up, and you got paid. So in 1976, I was cutting through one of the barns, and I noticed in one of the stall floors a $20 bill. Now, this was 1976. Folks, this $20 bill, in today's terms, was probably worth $100. Why? Because we have inflation, okay? Now, what's funny about this story is recently, as many of you know, we have, among many dogs, we have a black Russian terrier, sometimes featured on this show, by the name of Stella. Well, Stella's breeder was recently in a dog show at the Kentucky Horse Park. Since then, they've built a huge facility for such venues. This breeder is out of Atlanta, and she brought a couple of her black Russian terriers. So Susan and I decided to go out to the Kentucky Horse Park to watch her dogs work out. And they did a great job, by the way, a lot of fun. I kid you not. We're leaving the facility. Remember, at this same Kentucky Horse Park, again, this was this year. Guess what Susan finds on the floor? Aaron, you don't believe this, do you? This is a true story. She finds a $100 bill at the same facility, which in actuality, I told Susan, I said, hey, that's worth the same $20 bill I found in 1976. She didn't get the joke, but basically they were the same things. So basically this whole idea of money really is kind of an arbitrary term. But most savers, here's the key, this show is dedicated to helping savers. So most savers fail to understand that money is merely a game. Money, land, possessions, whatever has appreciated in value is in and of themselves really worth only what someone is willing to pay for it. Is this kind of making sense? And this is the essence of what we call fair market value. Folks, this may sound like, oh gosh, he's getting into economics. I've never understood this. You need to really hang with me. I'm going to make this understandable because this is really, really key for what we're going to be talking about today. Now, to get as accurate as one can on how to value something, included, here's a key, included in the definition of fair market value is also this notion of compulsion. In other words, when compulsion, that means the desire to buy something no matter what. You know, you're very compulsive. You just got to have it, that type of thing. So when compulsive enters into the equation, fair market value will always go up, which in turn, here's the key, in most cases dilutes or places uncertainty into the actual real value of something. Now let me give you an example. Let's say you have a piece of land. Maybe you own 10 acres of land, and let's just say for the sake of argument, it's located in the middle of nowhere and a bunch of woods, okay? So in this example, the land is only worth what some other farmers maybe nearby have sold their land for of a similar nature. Again, people have bought and sold land in this area for years, but nobody's ever been under any compulsion. So maybe we've verified over the last 20 years that no land in this area where you own 10 acres has ever sold for more than $1,000 an acre. So we pretty much know what it's worth. So it stands to reason that the fair market value of your land, these 10 acres, if we assume it's worth $1,000, is worth $10,000. But what if, kind of role play with me, what if there's this rumor spreading around your little community that a very, very large retailer is going to come in and buy some land for a new store they're going to put up? And ironically, the rumor says that they need exactly 10 acres of land with which to build their huge retail facility. So now, word gets out in the community about this. What just happened to the value of your land? Well, of course, you've got to speculate and say, well, shoot, it's gone through the roof, right? Because this retailer is going to pay more than $1,000 an acre because they want it. They're under compulsion, we assume. They need this property, and they're going to make so much money on it, they won't care. They'll pay whatever the land they think is worth. So the idea of supply and demand makes the property overnight, because we assume the demand just shot up, is much higher. Now, in fact, assuming others in the area really do catch wind that this retailer is getting ready to purchase your land, one of these farmers, let's say one of your neighbors, comes to you and they want to get a piece of the action. So maybe they go over and they say, hey, Tony, before you sell that land, we'd like to buy it. Again, they're speculating now because they've heard this retailer is going to buy your land. So Fred, the neighbor, comes over and convinces you to sell your land for $20,000 an acre. Keep in mind now, you don't have any offers, you don't know. So you think, well, shoot, if Fred's willing to give me $200,000 when it's only worth $10,000, you're going to take it. Yeah. So since you haven't actually had a formal offer from the retailer, you take the $200,000. Fred is smiling because he now thinks he's had a home run. He's speculating. He doesn't know this. He thinks he's investing because there's no contract or anything. He's speculating the retailer is going to come in and pay him $1 million, right? I mean, it's got to be worth more than this. So what happens over time? Well, unfortunately, in this example, let's say the retailer decides not to buy any land in the community. Fred's stuck with paying an extra $190,000, right? $10,000 plus the $190,000 that he speculated on. See, under compulsion, he fell into that trap. So now Fred's stuck with a $200,000 piece of property that really is still only worth $10,000. So now, Tony, why do you go on about this, and why is this so important, you might ask? Well, because I'm seeing speculation going on right now in the areas of finance, and there's two major areas that I'm seeing a lot of speculation on, and first is in the stock market. And you say, well, what are you talking about, Tony? Everybody's in the stock market now. Everything's going up, and that's my whole point. In fact, a great read on this, I'm always referencing Benjamin Graham's classic, The Intelligent Investor. And in it, Benjamin Graham has a great quote on this. He says there's a difference between investors and speculators. Well, let's jump to the point. A speculator is someone who invests in something they know nothing about, but stands to lose a lot of money. So think about this. If you've got all of your life savings in your 401k in the stock market, I know it's going great, okay? I'm all about the stock market. That's great to have a small piece, but to have all of your money in the stock market, do you realize how quickly this could go down? And if you don't know what you're doing, you're basically a speculator. Now again, we're recording the show on December 12th, 2017. The market's going through the roof. However, the timing of what had happened in 2017 and 2008, I see a lot of similarities here. Market back then was going up, up, up. Nobody wanted to get out. What happens? 08, 09, the bottom falls out before everybody realizes what's going on. There you sit. Some of you lost 50, 60% of your net worth. And especially if you're a saver and you're retired or approaching retirement, folks, these are scary times right now. It's kind of like that feeling of Fred, right? You lost all your money, and now you're sitting there holding a bunch of land that's not worth near as much as what it was worth the day before. So we don't have the same type of loan crisis they had in 08, but we have similar economic conditions, in my view, that are working in this supply and demand and creating a little bit of a compulsion out there. So assuming that all of your money is in the stock market, you have to realize something very important. That money is not real. You say, well, of course it's real, Tony. I see it on my statement. I've seen the value of the stock. Remember, a dollar is not real until it's converted to cash and used. It's on paper, folks, so be aware of that. And as we're doing retirement income planning, this is why for savers, we never recommend 100% of your money in the market. So if this is a fair market value in the 401k, in my humble opinion, it's really not the true market value. We've been propped up by feds, low interest rates. More and more boomers are putting money in the market, which is driving the price up just by nature of so many boomers having money in the 401ks. And of course, savers no longer have options in the bank at higher interest rates. So I believe savers have kind of drifted into this world of uncertainty, and again, thus pushing more and more money into the market, which drives the price up. But this latest thing I want to mention that has really gained some traction, something quite frankly I've never really heard much about until recently, and that's these Bitcoins, all right? A very, very recent phenomenon known as Bitcoins. Now, it's funny, I was at a recent conference with financial advisors, had nothing to do with Bitcoins. All these advisors claimed to be like me, working on safer investments with savers, but it was so interesting that some of these guys were caught up in the Bitcoin phenomenon. Man, they were getting ready to get their Bitcoins, couldn't believe I didn't have any Bitcoins, and I'm thinking, I don't even know what a Bitcoin is. So I start researching these things, and I started doing my homework, and what I basically found out is, hey, I'm not saying you can't make a lot of money in Bitcoins. I'm not saying maybe they will be the currency of the day, but basically, folks, these are highly, highly speculative instruments right now. And if you're a saver and you've been approached about putting money in Bitcoins, be very, very careful. Here's why. Because Bitcoins, although our dollar, you said, well, Tony, what about our dollar? You just said it went from a $100 bill in 1976 is worth $20 today. That's inflation. But at least we have with our monetary system a central bank and government regulation. Bitcoins do not. So therefore, the volatility of a Bitcoin is just all over the place. Again, may not be a bad thing, but the problem with Bitcoins, in my limited understanding, is these can go down very, very quickly in value. And right now, there's a real herd mentality because apparently there's only so many Bitcoins out there. And yeah, now everybody's getting excited. They want their Bitcoins. What's happening to the price? It's going up. So if you're a saver, I'm warning you, be careful about investing too much in these Bitcoins if you don't like speculating with your money. That's just one man's humble opinion. By the way, it's not just my opinion. I was reading in This is Investment News Magazine, a really good article by a gentleman by the name of John Wagner, and his title is, What History Tells Us is Next for Bitcoin. And what he says is, what history tells us is loosely defined a bubble. Let's talk about bubbles. You've heard about something being there's a bubble. A bubble is a rapid increase in an asset price that is not substantiated by any fundamentals. Mr. Wagner goes on to say that there are always rational sounding people who are offering very convincing arguments that an asset price in a bubble is perfectly reasonable. And we're seeing that with Bitcoin. I've researched, man, there's some sharp people. I've watched videos, very, very sharp people who, if you listen long enough, I'm thinking, hey, yeah, these Bitcoins do sound good. Very, very good arguments from reasonable people, but that doesn't mean you should speculate in such things if you are a saver. Incidentally, it's kind of funny. If you go back in history, many of you may have heard of the tulip mania. The first mania, where just people just kind of went into compulsion and started paying ridiculous prices for stuff, happened back in the 17th century during the Dutch Republic's tulip mania. Now, at the height of this tulip mania in February of 1637, a single tulip bulb, listen to this is interesting, sold for more than 10 times the annual worker of a skilled craftsman. 1637 event was popularized, and then there was a book written in 1841 called The Extraordinary Popular Delusions and the Madness of Crowds, written by Charles Mackay. I've got to get this book. In fact, Aaron, make a note of that. I love the title, Extraordinary and Popular Delusions, Madness of Crowds. So folks, that's why I wrote the book, Don't Follow the Herd. Just because everybody's heading in one direction doesn't mean you should as well. You need to take your time, make sure you understand what you're investing in. If you don't understand it, or if the old saying goes, it's going up very rapidly, it seems too good to be true, be very careful. Now, before we go to the whiteboard, I got some good stuff to show to you. Let me give you one more example of this idea of how quickly things can go up and down. January 2nd, 1980, gold, the price of gold was $559 per ounce. But in just 19 days, see, this is unexplicable kind of things. In 19 days, the price of gold soared from $559 an ounce to $850 an ounce. You know, speaking of gold, I'll share one more story. I'm on a roll with stories today, Aaron, but this is all true stuff. It's so funny. Years ago, I was up in southern Indiana conducting a workshop. An older gentleman came up. I think he even had overalls on, just a good old laid-back fella. And he said, hey, if you don't mind, people were kind of scurrying out the door and everybody was finished. I'm collecting my papers, and this guy goes, you mind taking a look at this financial statement of mine? So I looked at his financial statement, and it was an odd financial statement. He had all this farmland listed, had a ton of Apple stock. I later found out he bought that years ago. It was worth a fortune. But then all of a sudden it said cash. That's all it said. And it was a large sum of cash on this financial statement. And I asked the older gentleman, I looked at him and I said, why do you have so much money in the bank right now? Because it didn't make sense because he had so much Apple stock. And the older fellow looked at me and he said, well, I recently sold all my gold. And to which I looked at him and said, well, how come you sold all your gold? And this guy looks at me as if I'm crazy, and he said, because everybody's buying it. Did you hear that, folks? It was just intuitive. His point was, I'm not going to be buying something when everybody else is buying something. That's the time to sell. Might be some words of wisdom to ponder on. All right, when we come back, you say, Tony, that's all well and good, but I need something in my real world that can help me understand how to maybe think through the risk and reward associated with various investments. I'm going to show you something that's been around for years, but it's really, really a good diagram to understand. It's called the risk-reward pyramid. And when I come back, we're going to go over that. This is some good stuff. Let me get the whiteboard out. You're watching the Worry-Free Retirement. Did you realize that Uncle Sam has a plan for your retirement savings that could penalize as much as 50% of it? It's called the Required Minimum Distribution, or RMD. And regardless of whether you're young or old, retired or still working, you need a game plan to maximize your RMD. Visit TonyWalkerFinancial.com, click on the free RMD webinar button to learn the 10 strategies to maximizing your RMD. That's TonyWalkerFinancial.com, and we'll see you soon.
And now it's time for Tony in the Trenches.
All right, our Tony in the Trenches comes from Rick in Bowling Green, who asks, Tony, I'm getting ready to turn 70 and a half in a few years and want to know what to expect in terms of how much I have to withdraw from my retirement account and the taxes I'm going to have to pay. Well, good news for Rick and good news for you, because recently I recorded a webinar called Maximizing Your RMD, or Required Minimum Distribution. To watch this webinar, just go to TonyWalkerFinancial.com. You want to click on the icon, and then we can meet with you in person if you'd like to see the 10 strategies for maximizing your RMD. Folks, if you mess this up, there is a 50% tax penalty. So take advantage of the RMD webinar. If you're coming up on this age really soon and want to meet with me to learn about these 10 strategies in person, again, click on that Let's Get Started and tell us that you want help maximizing your RMD. All right, let's get to it. Aaron says, chop, chop. We're kind of running out of time. This is something up here years ago I saw, and they still use it today. It's called the risk versus reward pyramid. Now, basically, and we might cover this next week, remind me, Aaron, in case we're running out of time, but there's really two types of return that are associated with money. Most people always want to talk about internal rates of return. In other words, if a stock goes up 20%, they say, well, that's the internal rate of return. But the external rate of return is just as important because the external rate of return takes into consideration any costs associated with the internal rate of return. Let me give you an example. It'd kind of be like you were running a fast food chain and all you ever look at is sales. You say, well, I sold $1 million worth of hamburgers this month. We're just making so much money you can't believe it. Well, that'd be the internal rate of return, and that's a lot of hamburgers. But what if your cost were $1 million? Well, you'd make zero, right? This is why it's so important to work with an advisor such as us that truly understands the four costs of money. Folks, anybody right now with the market up can make a lot of money, but what is the external rate of return? That's something we can help you with. But for this purpose, we're just going to talk about the internal rate of return, and the risk-reward pyramid, especially for savers, says that the majority of your money, the support of your money, should be in very safe assets, okay? And what that means is these assets, the principal, should be 100% guaranteed. 100% guaranteed. We talked about the value of a dollar, and I realize with inflation the dollar doesn't buy as much anymore, but nevertheless, this might include government bonds. See, unlike bitcoins, they're at least backed by the full faith and credit of the government, so we know that there's some backing. Another thing would be bank instruments, okay? It'd be products like money markets, CDs, cash in the bank. Banks, although they're not paying a lot of interest, folks, provide principal protection. And then finally, my favorite would be fixed annuities, okay? Fixed annuities. So there are other things that might fall into here, but these are the three primary tools that we use for savers that are guaranteed in terms of their principal. Now you might move up this pyramid a little bit more, and you might have something like pretty good grade corporate bonds, okay? You might even have, we'd probably put up here maybe large value stocks might go here. Again, there's no right or wrong answer to this. Everybody's different based on their financial personality and risk tolerance. So we're all kind of different here. But what I want to show you is you move up, notice you should have less and less money in what I call speculation. And in this example, that would be things like gold, bitcoins, that would go up here, all kinds of things. It doesn't mean you shouldn't do them, but obviously you don't want bitcoins, if you're a saver, being your primary asset. You reverse that. So maybe you're sitting there going, Tony, I've not had anybody ever explain all these different risks. I don't know anything about external rate of return. I want to take less risk, but I want more in my pocket. How do I do that? Well, it's very easy to do. You got to get started. So why don't I invite you now to go to TonyWalkerFinancial.com. When you get there, just click on that Let's Get Started button. You would meet with me in person at no cost or obligation. Again, while you're there, don't forget to check out our brand new free RMD webinar that's been pre-recorded to learn how to maximize your minimum distributions. Well, does the Bible have anything to say about bitcoins? No, but it has a lot to say about slow and steady wins the race. And I'm going to share with you 5 very important principles that are going to keep your hand to the plow and keep you focused on what's most important to you. That's protecting your hard-earned money. I'll be right back, but I got to get me a cup of coffee. Did you realize that Uncle Sam has a plan for your retirement savings that could penalize as much as 50% of it? It's called the Required Minimum Distribution, or RMD. And regardless of whether you're young or old, retired or still working, you need a game plan to maximize your RMD. Visit TonyWalkerFinancial.com, click on the free RMD webinar button to learn the 10 strategies to maximizing your RMD. That's TonyWalkerFinancial.com, and we'll see you soon. Oh, good cup of coffee. Welcome back to the WorryFree Retirement. Let's take a quick look at what the Bible has to say about money. And more importantly, when I started the WorryFree Retirement, the concept was life is more of a marathon. It's not a 50-yard dash, folks. And I think when people speculate with money, they're hoping to hit it big. And in most cases, that's very difficult to do, or at least in my life. I've found that it takes a lot of work. It takes a lot of time. And we're going to talk about perfecting your walk. That was my first book, incidentally, for perfecting your walk. And I think it's a biblical concept. And what we're going to do is we're going to figure out, okay, how can we get some help from the great writer Charles Spurgeon and talk about the 5 things that we must do to continue to make our walk with the Lord one that is consistent and one that keeps us on track, not a life of fits and starts. Let's throw up real quickly, Aaron, Colossians 2:6, which simply says, "As ye have therefore received Christ, just as the Lord, so walk ye in him." So what Spurgeon goes on to do here is tell us the 5 things necessary to prove that we have evidence that we are following and walking after Christ rather than walking after the principles of the world. And these 5 principles to be worry-free are as follows. Number 1, you have to take action. Walking implies moving. And it's interesting when people talk, and I'm going to do this, I'm going to do that, but until you get up and take action, nothing happens. So take action. Do something. You've got to start walking. Number 2, walking also signifies progress. Even though you're making slow progress, you're walking. You're going to get there. And if you try to run or you try to dash, you get tired. You can't do that forever. So actually walking is a better pace in life than running. Number 3, walking implies continuance. So for a Christian, this means perpetually we are abiding in Christ Jesus. We are walking with Him continually, and this should be a great reassurance to us. The 4th, we'll call it habit, or thing we're supposed to do to keep on this track, is when you think about it, walking is just that. It's a habit. I got up here for a minute ago and got my coffee. I didn't think about walking. I didn't say, I'll put the right foot forward, then the left. I've walked so much, it's become habit. And as we read Scripture, as we follow Christ, the habits of following Him and doing what He would like us to do for Him and for others becomes a habit. And then finally, and this is the biggie, and especially in money, sometimes all of this requires a great measure of faith. So we as Christians, here's the key, we must not walk by sight, but by faith. And when it comes to money, this is very easy to get off track because we tend to want to watch others. We want to see what we're doing. We watch the Bitcoin phenomena or whatever it is, and we stop walking and we start running, and sometimes we're running down the wrong road. So what about you? You may be sitting there saying, Tony, I'm kind of like Spurgeon, you know. Spurgeon said a grain of heart's ease is more value than a ton of gold. I want to be more worry-free. I'm tired of chasing after money. I'm tired of feeling like everybody's making more money on my money than I am. I'm tired of, as you say in your book, Don't Follow the Herd, feeling like I'm drinking downstream from the rest of the herd. What can I do? Well, all you got to do is go to TonyWalkerFinancial.com, click on the Let's Get Started button, and let me help you set up a game plan that's right for you. The game plans we do, I've done these for over 33 years. They're simple, they're easy to understand, and more importantly, they're bent more on safety than on speculation. So take action. We just talked about that. Start walking. Walk on over to the computer now. Log on to TonyWalkerFinancial.com. Click on the Let's Get Started, and I'll look forward to seeing you soon. In the meantime, I hope you've enjoyed today's program. I've enjoyed being with you. So between now and next week, between now and the time I see you again, if all else fails, remember to be worry-free. Make it a good one.
Thank you for watching the Worry-Free Retirement with Tony Walker. If you need a safe and simple game plan for your retirement, log on to TonyWalkerFinancial.com and schedule a free, no-obligation meeting with Tony.